Thank you everyone for taking the time to join us this morning. My name is Sandy Kirkpatrick. I'm one of the account managers here at the Thames Valley Chamber of Commerce, and I'm delighted to welcome Barry and Robin from BRIXX. BRIXX are a small technology firm based up in Henley. And very interestingly, I was getting a bit of the history of BRIXX from Barry and Robin post, just before the webinar this morning. So I'll let them fill you in on exactly how the company started and their history. BRIXX have been a long-standing and very valued member of the Chamber, and we're very happy to have them within membership. So today's topic, as you can see on the screen in front of you, is making better business decisions in the most volatile market in history. And I'm sure that couldn't be more true today. Whilst there is some scope for optimism, I think there's some very challenging but I think cautious optimism to look forward to in the coming months. So very applicable topic that we're going to be talking about this morning. And well, without further ado, I'll just hand over to Barry and Robin. I will say that the webinar will be recorded this morning, so it will be available on our YouTube channel and on the website post-webinar as well. There is a chat function which everyone is more than welcome to use. We will be having a Q&A session, I think, at the end of the webinar. So please feel free to use the chat function. Fire in any questions that you have to both Barry and Robin, and they will be more than happy to answer your questions at the end of the webinar. So without further ado, I will hand over to Barry and to Robin. Good morning.
Good morning, Sandy. Thank you. Thank you very much for that kind introduction. Thank you to everybody for sparing some time to be on this webinar this morning. I find it a little disconcerting that I'm talking to a picture of myself and Robin and Sandy, but I hope everybody's there in comfortable circumstances. Look, I'm Barry Baxter. I'm joined by Robin Booth. We work, as Sandy said, in a small company in Henley. Our stock in trade is really financial modeling, and we're a software company that deploy this and make it available through a SaaS model. But what we really wanted to do today was to talk to you about financial modeling, business modeling. And we sit in an environment which is the most volatile I'm in my 60s. It's the most volatile period I've ever encompassed. And it's not that there haven't been volatile periods before, but it's the not knowing, it's the unknowns going forward, and us having to envision what is going to happen. And to that extent, you know, we're all familiar with the business plan. We've done business plans, and you know, for a lot of us, especially in the corporate environment, it's get that done, put it in the drawer, and don't look at it again. But what we're going to propose is that actually, because of the volatility, because you've got to make decisions every day, you're better to have a financial model. And what are the attributes of a financial model that that you need? And so a financial model is a simulation of your business. It collects together the activities of the business, the financial activities of the business. It structures those, and most importantly, in the best financial models, it understands time. So we're all used to using spreadsheets. I've used them all my life, and I've run some fairly major divisions and businesses on spreadsheets. And I've lived with the linearity, I've lived with the lack of integrity, and I've lived with the lack of flexibility for the question I'm trying to answer. So by way of demonstration of that, I'm going to hand over to Robin, who's going to talk about his real life experience before he came to BRIXX and the business he was involved in and the challenges they had, and what he now sees that he would have been better equipped to handle had they had a financial model or a financial modeling system, which is what we're really talking about. I'm going to hand over to you, Robin, right now, and let you pick it up and explain your background.
Yeah, thank you very much. So as Sandy introduced, my name's Robin, and I've worked in a few small businesses around the Thames Valley area. They've all been technology businesses, and I've learned a lot through these experiences of mine. I'd like to tell you a story today about the first business that I was involved in, and I can spoil this story immediately by telling you that this business no longer exists. Okay, so this is the story that I want to tell you, but I want to tell you this story using an unusual medium, and that's the medium of a financial model. So I want to show you how this system can be used not only to ask questions about the future, but also to convey what a business looks like financially in an easy to understand manner. So I'm just going to start off by sharing my screen here, and I hope you can all see this. I'm going to be using a piece of software today to talk you through how a financial model works. And I'm not ashamed to say that it's our piece of software, but other financial modeling tools are available. So the key thing that I want to get across today is how a financial model works and how it is different to other methods of planning. And hopefully you'll see that, well, you'll come to agree with us that this is the way to plan businesses for the future and the best way to ask questions in uncertain times. Now, when I joined the business that I started after university, it was 2008. It was in the wake of the 2008 financial crisis. So it was not a great time to be looking for a job, but I was lucky enough to be employed by a tech startup in Henley-on-Thames. They were a digital audiobook retailer, selling audiobooks that they licensed from publishers all across the world. We had quite a good start because we were differentiated from the other businesses that were in this space. Our major competitor was Audible, who a few years previously had been bought by Amazon. So we had tough competition, but we had our niche, we had our way to market. I'm going to tell you the story of this business. First, I just want to give you an understanding of what I'm going to be showing you, because I'm going to be showing you this business in terms of a financial model. Now, when you think about financial model, you might be thinking, it's all spreadsheets, it's rows and columns, it's the domain of experts. But I'm going to show you that it's actually simple. So here I've got a blank model. This is where I'm going to build up a structure of a business as I draw it on a piece of paper, and then see the financial outputs of this on the right-hand side here. Now, our business was an audiobook business, and one of the first things that we think about when we think about a new business is, where is it going to make money? How is it going to sell? Well, we had quite a simple method of selling. We licensed audiobooks from publishers and we sold them. So I'm going to add a bit of structure here to my plan and add a group here called publishers. So I'm dividing up this financial model in the way that I think about it as a business. I can now add individual building blocks to a model. These are calculators that perform a specific financial task, like add a source of income to the model, add a cost, employ someone. These are real business activities, not rows and columns on a spreadsheet. These aren't accounts. This isn't the language of accountancy. This is the language of business. But what we can do by adding these items to a model is make the language of business into something that outputs the language of accountancy, into something that turns and transforms these business activities into professional reports and dashboards. So we sold by publisher. I'm just going to add one of the publishers that we sold here, Random House Audiobooks. It was one of the largest audiobook companies at the time. And I can make an assumption here about how much I want to, how much I plan that I will be selling of this audiobook publisher. So I might add a unit price of £10 and expect to sell 100 units a month, for example. Now, if I just add this one element to my model, I start to get these figures flowing through to the different areas that I would look at financially. I can see immediately here that I have a dashboard where I'm getting sales of £1,000 a month, as what you'd expect, and an increasing amount of cash each month from this one source of income. But this isn't the only output of adding this publisher. I can also see in more detail in my reports what Random House Audiobooks is generating for this business. And I can see that I'm getting cash from these audiobook sales, but I can also drill down and find out exactly where that cash is coming from. So this structure on the left that I've built is actually being replicated here in my reports. And this is one of the big differences between a financial model and a plan. In a model, this section here on the left, I can change in any way I like. I can ask questions of it. I can structure it to reflect my business precisely. And no matter what I change here on the left, I can see the outputs of that with complete integrity on the right. The calculations are unaffected by my structure here, by anything that I might change. I don't have to go in and look at a calculation or a formula in a particular cell and check that it's still going to the right place. I can add more publishers and more elements to the business. So I'm not going to spend too long going through this, but I just want to show you some of the basic functionality that a model has if it has to be flexible. It's something that from just a single business activity can start to produce a full cash flow, a full profit and loss report, and a balance sheet as well. So it's looking at every aspect of a business from just this single source of information. And as you start to add more elements of the business and build up this real world picture of a business, you'll see more and more of this information coming through. And I'm going to show you a full model in just a moment. But there's one other critical element that a business model must have. It must have an understanding of what it's modeling. And here we're talking about the future. We're making assumptions about what may happen and then questioning those assumptions. And anything that happens in a business happens at a particular point in time. And this brings me to a timeline. So a financial model should take place with an understanding of time. I should be able to change when anything happens in time and have the model react to that very, very quickly and easily. So if I decide that my contract with Random House doesn't start for another 2 months or 3 months, it should be as quick as dragging and dropping something on an interface to see the effect of this in my reports. You can see that Random House's income now starts 2 months later into the model. So this is the basic functionality of a model. Removing the input side from the output side, having a translation between them that allows you to change, flex, and ask questions of the model without disrupting what you're doing on the output side. Now I'm going to show you a real business now, the business I was involved in, and tell you a little story about it. So I mentioned we were an audiobook business. We had a really great boss at this business. He was a very persuasive ex-recruiter who had gone to America and got contracts with all of the different major audiobook publishers. And you can see them here. We got Random House, Blackstone Audio, Hachette, all of the major publishers. We had a really great team around us, hiring about 8 people initially, and we were set to take on this established business, Audible, with a very different method of selling. We set up our business initially with, as I said, all of these audiobook publishers and the fees that we paid to each publisher. We also decided that eventually maybe we wanted to develop our own audiobooks. Maybe we wanted to set up our own studio. That was a few years down the line, but we'd then be able to not sell audiobooks and have to pay a fee to the publishers because we would own that content. Of course, like any business, we had our operating costs. We had an office that we actually owned through a mortgage and we paid utilities on. We used software, so we paid for licenses, and a lot of other costs that we had were around the development of our ability to provision those audiobooks. We allowed them to be streamed from our website. So web development and the maintenance of our website, and eventually the creep of features to do with that website, were major costs to the business, and major initial outlays. We also had a number of staff and plans to hire more in the future. We spent a lot on marketing, both local and digital. This was before the age really where digital marketing became its own massive industry. We were just taking baby steps into it and starting to use Facebook campaigns. We owned things as well as a business. We owned the computers that we use. We owned our desks and chairs. And as I mentioned, we had a mortgage. So we actually owned the office in which the business ran. As far as funding went, the owner and a few other stakeholders funded the business completely. Now, there's a bit of a straw man in this business I've built up, and you'll see it's this next element, expensive shows. We went on some pretty expensive shows. We went to Orlando in the United States in the very start of the business, to a really beautiful hotel there, and spent a lot of money and intense activity on this show. The result of which, unfortunately, did not match the cost that we'd incurred to go on it. Now, this is, of course, hard to predict, and I don't want you to feel like I'm looking back at this business now with the benefit of hindsight and saying, oh, look at this cash line, you can see this isn't going to work. Our costs are way too high. Our income wasn't sufficient to run the business. And hindsight is fine. We can talk about hindsight now, but it's not useful to the business at the time. What is useful is being able to ask the kind of questions that we might ask of a model like this one I'm showing you. So in reality, what we did as soon as we launched the business and went to the show and found that we weren't doing as well as we had hoped by quite a severe margin, we started to panic, frankly, because we had to do something about this. We could predict the next few months, and we could see that they were not a good sign, right? But what we couldn't do is look at our activities and see the consequences of those activities a year or 2 or 3 down the line. So we had to cut costs in the business. We couldn't cut the costs of our provision of audiobooks because that was the business. We'd already spent a lot on marketing. So unfortunately, the thing that we had to cut was staff. We couldn't make these future hires because we couldn't plan to do this yet. We didn't have the revenue to support that. We found that actually the business could probably make do without a technical manager. Let's just see the effect of this on the dashboard. Okay, so it's a little bit better. Now, we weren't getting enough new business in order to justify a business development manager. So unfortunately, we didn't have a business development manager anymore. And eventually, the boss of the company had to go back to recruiting to support the business. So we didn't even have an operations director. Now, things are looking a little bit better, a little bit more manageable here. But what we've done and what we did was hamstring the ability of the business to grow. These 2 members of staff, this is actually me and my wife, we were unable to do more than just run the business. However, more efficiently we could each month as we learned how to use these new systems and cope with a very small number of staff. We could just keep it ticking over. We couldn't grow it. We couldn't solve the problems that this business faced. And I'd argue that if we'd had something like a financial model that showed us a full picture of every aspect of this business, that let us see what was costing us money, that let us build it in the way that we think about it, and see which sources of income were the best for us, which publishers we were making the most money from, and be reactive to changes in our reality. So change this model as time went past and change how we saw the business and how we saw the priorities in it. Then we'd have been able to make much better decisions. Now, I wouldn't want to go back in time and give myself specific advice because that's cheating. But what I would want to do is go back in time and say, find a way to ask questions about the situation that you're in. Now, if I could go back in time and cheat, then of course what I'd do is not go to Orlando. Because if I don't do a lot of expensive shows, things don't look quite so bad. We're still not on a great trajectory, and over the course of several years, I think we're actually skirting pretty close to problems here in the second year, but we managed to recover. So we obviously went to this show in Orlando thinking that it would do well for us. We didn't think that we would have a low number of expected sales. We expected that they would be much higher, that this would be a great opportunity for us. But as soon as you start putting something like high expected sales into a financial model, it begs the question, what happens if your sales aren't so high? What happens if they're much lower? Yeah. Now, I want to end here with a question that I had when I left this business. And that is, I'd had quite a traumatic experience here as my first major job in a tech startup. And I thought this meant that it was impossible to plan for the future because we'd had plans. You know, we'd had everything planned out. We assumed that we'd grow like 10% per year. That seemed comparable. That seemed something that the market would make sense to allow. And I thought, how can you make a plan for the future if, you know, it could all go up in smoke? And the answer is you can't ever predict exactly what's going to happen. Anyone who makes a plan knows this, that, you know, the one thing you can guarantee about a plan that you make is that it's not going to happen exactly the way that you plan it to. But the benefit of having a financial model, and this is what I came to realize as I learned more about financial planning, it's not that it shows you exactly what's going to happen in the future, because you'd have to be a soothsayer or have a crystal ball in order to know that. It allows you to ask questions about your business. It allows you to see the consequences of your actions over time, and lets you look at the decisions that you're making now and see them in the context of your wider business. So I no longer think that it's impossible to plan for the future. I think in terms of questions. And the more questions that we can ask and the easier it is to ask them, I think that can only be for the good of every business who's contemplating their future. And especially in times like these, it's been impossible to rely on just past performance and extrapolate that. You have to have a way of understanding your business that's more holistic, that's built up of bottom-up components that allow you to see that granular output in financial reports in terms that are usually the domains of accountants and finance experts, but to see those in the way that a business owner understands them. Now, I'm going to leave you in just a second, hand back over to Barry, but I think that having shown you this today, you've seen the kind of questions I've asked of this financial model of a real business, of the audiobook business that I was part of. I think that you could, every one of you on this call, could take this financial model right now and start asking questions of it. They may be the same questions that I've been asking. They may be completely different questions that I haven't thought of. But I think you could start to use this to ask questions of a business that I just introduced you to 15 minutes ago. All right, I'm just going to hand back over to you, Barry. Thank you very much. Oh, I think you're just on mute there. Yeah, there we go.
I love listening to you talking about that business, Robin. I've listened a few times in the past, and you have a really nice delivery of that articulation of people who run businesses, who understand their business and the components of that business, and we compute what might happen in our head. We'd all love a crystal ball, but we don't have one. So we tend to foresee the future in our own head. It's a bit like playing chess. You look at the consequences of moves that you can make now, and they're the decisions that we're talking about here. And if you've got a tool that allows you to visualize your business, to understand the scope and the structure of your business, then you need it in a form that you can ask the what if. You can say, well, what if we put the prices up? What if we restructure our workforce? What if we undertake a marketing activity, and see the consequence of that? Now, I think in your instance there, going to Orlando, that was probably, in the eyes of the owner, that this was the right thing to do, and you'd have probably still done it.
Yeah.
The thing is, if you had a business model, you'd have done it with your eyes open. Okay, this is a very risky thing. We are putting all our eggs in this basket. Now, we might want to do that, but this whole risk management is about understanding the potential returns on those different decisions that we can make today. And the thing is, we're human beings. We live in this time continuum, which is why this is so important. And we look back and learn from the past. And if ever there was a time where the past is not a predictor of the future, it's right now. And so all we can do is make decisions today that have consequences in the future. The better our understanding of what those financial ramifications in this case may be, the better informed we might be to make those decisions. And that's what a good model does in terms of separating the input from the processing of that through the chart of account in our case, and then the output in terms of those reports that we are looking at. So if you think about that timeline, we move through time, and there is a past, and the online accounting systems of today are the most dynamic way of looking at that past. And we look to the past, obviously, to predict the future, because we find behaviors and output from that, but it informs us to make a better decision. If you have a financial model that can connect with the past, and so at one point in time, we make a plan for the year. The plan isn't an output in its own right. The plan is a consequence of running the model, multiple scenarios, looking at the input and the output, the effect of different choices we can make today. And then we determine that one of those becomes our plan. Now, I can tell you 40 years ago that went in the drawer. I've done that. That took me 2 months to get that plan. I've now got it in the drawer. I'm not going to look at that again. But the fact is that we're human beings. We move through time. We're in a volatile period, and that environment changes and will change and is changing. And therefore, we need to have a model that's live, that's living with us. And as things happen, as the Prime Minister makes an announcement about coming out of lockdown, as there's a subsidy in one way or another, as there's a market emerging in another, as we pivot our business to look at things in a different way, we need to envision that. But we do need to connect it to the past, and we need to bring in the actuals. As we move through time, we say, well, okay, this is what we plan to do. And at the end of that period, whether it's a week, whether it's a month, we can see where we're up to. We can see where we're strong, where we're weak, where decisions that we made are paying back or not paying back, and most importantly, allow us to react to that. And if you have that simulation on your desktop, then you can play through this new scenario. You can remodel the future as a continuous thing. It's what we do in our heads. You know, if we're playing a sport, we're moderating what we're doing all of the time because we're envisaging a different outcome. And we need to be able to do that in business, not static. And those agile businesses that are able to do that, that have a good view of the potential ramifications of decisions today, will be better placed in order to do that. So make sure your model understands time. Make sure it's at a granularity that you can see the wood and the trees, that you can see where you're going. Have a model that is usable by the business people, not just the financial accountants, not just the person that creates the spreadsheet. The IP of that business needs to be in front of you. You need to be able to ask those questions yourself, whether you're a divisional director or a manager of the factory. You need to be able to ask those questions easily. You need to be able to get the financial language that comes back, that Robin described earlier on. And I think if you equip yourself in this way, then this gives us a better chance. This de-risks the business. We can make risky decisions, but we're going in with our eyes open. And so, in a nutshell, that's sort of why model. We had and I'd like to open it up to two questions. John Panzak asked us a question there and talked about the Lycan concept of the language of business. But there's a formality to the history, the preparation of accounts. But those accounts merely represent the financial activities of your business. It's not a dark art to convert what you do into the financial ramification. They're direct. They're as direct as Robin described there when he put a sales transaction in. Businesses are just those multiple transactions. But if you have the understanding of the past, so if you apply the model to the past, you can understand these groupings of income and expenditure, assets and funding, what got you to where you are, and then to ask the question of what can we do going forward, what are we likely to do going forward. So it is a continuum. It's not a separate exercise to look at the future. We are all educated by our past and our experience. And that better enables us to ask better questions, to contemplate better ways forward. But then seeing that in financial terms is the most important thing. Robin, you can see that question too. Do you have anything to add to that in answering John's question?
So I think we've talked a lot before between ourselves about historical data and how that might transition to looking at the future. And in some cases where you have a very steady business that isn't really changing and isn't likely to be impacted by big changes in the market or in the way that we do business, then you can judge how that business is going to go and how, say, your sales are going to progress based on past behavior. But that assumes that you're not changing anything in the business. That assumes that you aren't making new plans, taking on new ventures and changing anything to do with the way that you do business. As soon as you deviate from the past, you start to move into an area where you're building up something that's asking new questions about the business and putting in new streams of income or new possible costs you could incur. Now, I do think definitely that there needs to be some junction between past performance and a model that's looking forward, because you want to see that change over time. That's really important, especially if you're looking at something month on month. You want to be able to see the trend and what is changing in a particular part of your business, which part is performing well, which part is not performing so well, where you're consistently getting higher costs, for example. And that's where the importance of having actuals to show against your forecast comes in, to be able to marry up that past information, because the past is always rapidly catching up with us, to the forecast that you've built, and then reforecast it using your model.
Okay, so let me just give you a little bit of background of BRIXX. We've been around doing this for some 20 years or so, and we've applied BRIXX, which started life as a C-based object-oriented application, which allowed you to get that visual of the business, the different groupings of income and expenditure, etc. And we applied that to many industries. We applied it to retail, to football clubs. It was a great pleasure for me as a Liverpool fan. Sorry if I've turned off half the people here, and I am crying at this point in the season. But to get a call from Liverpool Football Club to see if we could help them. And if ever you want a demonstration of a volatile business in itself, that is football, where the outcomes are not predictable. And we built models for many football clubs up and down the country, a modeling toolkit that's allowed them to ask those questions. And it was hugely successful in that space because of that volatility. We also came across customers in the social housing arena. These are the public-private partnerships that were built up to take over the old corporation and council housing stock, and to be able to run those as a more commercial enterprise than the councils were unable to do. And they had the challenge of, in their regulated environment, having to make a regulatory return every year, which was a 30-year model. And of course, it's time-based, and of course, a lot of things happen over time. And BRIXX became the dominant software that was used in this sector, and Housing BRIXX is still used today as the sector norm, if you like, for 30-year modeling. You can imagine the challenge that the regulator had, having to take 500 spreadsheet creations and try and amalgamate those. It's an impossible task, yet BRIXX allows people to do that because there's a common chart of account sitting behind. Even though the shape and size of every one of those housing associations was different, the components were the same. The things that Robin showed earlier on, the components were the same. The accounting practice and the backbone chart of account was the same. The output report was the same. And so that allowed for that consolidation process. But there was a 30-year time frame. The football clubs didn't look 30 years ahead, they looked 30 minutes ahead, because the chairman had just bought a new player that you then had to put into the chart of account, and you just paid 20 million for them, and at the end of 2-year contract they were worth nothing because of something called the Bosman ruling, and so you had to then go and find a way to pay for that player, highly related to performance. But our software has been applied in all of these ways, and that was an analog business for us when we started around about 2002, 3, 4, and we wanted to move it to effectively democratize it, to make this available for anybody that had a business idea or was involved in a business and wanted to visualize the future. And so, you know, we've been very fortunate to have lived in this age where we've moved through better hardware, better devices, better accessibility of IT, faster speeds, bandwidth, the internet, and now we present BRIXX as a SaaS model, accessible and deployable by anybody, and that's what we've done in terms of pivoting our business. We've moved from that very hands-on training based business with a complex piece of software that you need to understand to what I like to call stupid simple, deployable by anybody that's got a business idea and wants to turn that into numbers. And that sort of brings us to where we are today, and you know, fortunate enough to be able to talk to you today. We sell in 70 countries around the world, and we've just connected, to John's question specifically, we've just connected through the API to Xero and been appointed as a Xero partner app that allows you to connect the past to the future, and then as you move through time to review that and optimize your business going forward. I'm really happy to take any other questions if anybody else wants to throw anything up there. Any Googlies we're happy to engage with, or happy to engage directly afterwards or at any time. I better hand back to Sandy. You want to say something there, Sandy?
Yeah, I was going to ask a question myself. I think it was, well, firstly, thank you both for the talk this morning. Hugely interesting. I think hugely powerful as well, to be able to incorporate that element of time into your spreadsheet. And I think from my point of view, in a previous life prior to joining the chamber, I used to. I started and ran a brewing company in the sort of height of the kind of craft beer boom. This is probably what, 4 or 5 years ago, and I went out to raise external funding for that business, partly down at the Henley Business School with the business angels down there. They're a fantastic crowd, but it was really interesting. And the question is around the accountancy piece, and it touches on what John has said in terms of I always struggled with the language of accountants, but I fully understood from my business income. I understood cash flow when you've got X number of thousand of receivables out there, but you've got no money in the bank. You understand the language of business, but I always struggled with the language of accountancy. And to cut a long story short, I probably spent about 6 weeks modeling this business when raising external finance in spreadsheets, and it took me ages. And the accountant charged me a pretty penny to check it, etc., etc. And if I'm honest, it was a thing of beauty by the end. But there was a hell of a lot of time in it, and it was, the accountant. It was the spreadsheet itself was an accountant speak. But any time I went to speak to external investors, their questions were the questions were the same, and they were all on the business side of things and saying, what happens if your sales double? What happens if your sales half? What happens if you get 10% of what you think? We had a big contract with Waitrose. What happens if that goes? And it was being able to react and give them answers effectively to those questions. But what I was amazed that the accountant, and okay, this is 4 or 5 years ago, but you're saying that, BRIXX has been up and running, and imagine, competitors and other softwares have been around for a long time. Why is there such a lack of, if there is any accountants, I apologize, but I probably shouldn't blanket all accountants with my experience with accounting that I used at the time. But is there a reluctance from accountants to move to software rather than spreadsheets, or what's the feeling in the accountancy side of things in terms of software like this?
The accounting profession has gone through a revolution. We're now the biggest accounting packages, the fastest growing accounting packages are online. And I work with people that would have had a minor heart attack to think that all of their data was in the cloud. So the world has changed and is changing, and it's changing at a pace. So this propensity to use software to do the heavy lifting. Why try and program the balance sheet, the P&L, and the cash flow in a spreadsheet when there's a piece of software that does it? And actually, you want, and what accountants want to do is be selling, I'm presuming here, higher level services. So they could spend 80% of their time producing a spreadsheet and 20% of their time looking at the outcome of it. But the value's in the outcome of it and the different scenarios that produce that outcome. And that's where you want your expertise. You want to be looking at funding options, resourcing options. You want to be looking at tax optimization, structural optimization, and that's where the accountant's skills are. And if you're deploying an accountant to spend all their time creating the spreadsheet representation of the business, you're not utilizing them to get their expertise on how the business should move forward. And in that housing sector, you can imagine, we came to this housing sector, which was very well established, had some very big players, top 4, big 4 players in there, specialists in there. And here we come along with this funny sounding little company that, you know, allegedly has got the a crystal ball for the future. And slowly people started to deploy and started to realize that there was huge value in having this very simple piece of software. The resistance in the sector typically came from the owners of the spreadsheets, who would be the CFOs in these businesses. But, you know, the reality was that they were spending 80% of their time creating spreadsheets, getting them done, you know, 2 minutes before they go into the meeting. And when BRIXX came along, it allowed them to produce the model of looking forward in 20% of the time. And so that process of that 30-year model, which would typically take 6-8 weeks to prepare, became 2 weeks to prepare, which meant you had 6 weeks, 4-6 weeks of a balance to look at it and look at the and be creative about the business going forward. Look at the, you know, the optimization of the funding or the structure, or the, you know, consider different development options. So you move the ball, and our biggest advocates in that sector were those very self-same accountants that had created those spreadsheets, had that ownership of that spreadsheet, but nobody in the business could sort of get into it without going through the accountant. Now, I think that period is slipping behind us dramatically, as, you know, a new generation of people come through who are more happier to adopt these later technologies. So, you know, it's been a terrific experience to see that transition. And accountants today, I think, you know, are a very different environment to the past. It's not just about bookkeeping, which is sort of what one would traditionally think about an accountant. Accountants are your, you know, they're your financial advisors. They're the people that know how to optimize business from their experience, and to be able to play that through a model and to demonstrate, you know, the restructure or the refunding or the pursuit of a new market is vital. So I think I hope that's not too rambly an answer, but accountants in that sector became our biggest advocates.
Interesting.
They realized they got their time back and they could concentrate on growing the business.
I think that's a fair point. I think the scope for human error in spreadsheets is infinitely more. You know, you can spend hours looking for if the minus is outside the bracket and all this kind of stuff. Whereas I think with the model, that, you know, the power of software, that takes away a lot of that. As you say, it's the heavy lifting piece that I think's interesting.
Worried. You don't want to be worried about the integrity of the model. You want to be able to ask it the question. And you know, testimony to the advance of BRIXX in that housing market was that a lot of boardrooms started using BRIXX Live. Now, in my past, I've seen somebody present a spreadsheet as a major corporation, had an error in it, tried to fix it. Whilst they were there, it collapsed, and it becomes a career limiting period when you're trying to do that. But it's testimony to what we do that it's used in the boardroom. So you can ask real life questions. Well, hang on, what if we don't put the rents up next year? What if we, and then you can look at the cash consequence of that. You know, we'll need to find a new funding stream if we don't do that. So it might be the right thing for the marketplace, you know, social housing. Nobody wants to really put the rents up. You want to build better and more provision of accommodation, but you can ask those simple questions, and non-accounting members of those boards were able to ask those questions and see the consequence, and then deal with the consequence of that in terms of a creative solution.
Fantastic. Thank you very much, Barry, and thank you very much, Robin, as well. Very well presented. If there's no more questions this morning, then I think we'll wrap up. Very insightful, very powerful piece of software as well. So thank you both for taking the time out this morning to come and enlighten us about the subject. I hope everyone has found it useful. Thank you all for your time this morning, for giving up your time to come and join us on the webinar this morning. Barry and Robin are available, and you will be able to contact them. I think your details are all in the members portal. So if TVCC members can log in there, then you'll be able to find BRIXX. That's BRIXX with 2 X's. Then you'll be able to get Barry and Robin's contact details. I think it's just Robin at brix.co.uk, isn't it? And Barry at brix.co.uk.
BRIXX.com.
BRIXX.com.
Sorry, BRIXX.com, my mistake. So yeah, please reach out to them, have a look into it in more detail. I'm sure they'll be able to answer any more questions that you all have. So on behalf of myself, Barry and Robin, thank you all for your time this morning, and have a fantastic rest of the day.
Thank you very much, everyone.
It's been a real pleasure. Thank you very much, Sandy.
Thank you. Cheers.
All right.
Bye. Bye.
Bye.